I'd like to introduce our panelists, and again, I thank them for coming. Michael Maturo, Managing Partner and President of RXR Realty, a multi-billion-dollar private real estate company that manages commercial real estate properties and investments comprising approximately 25 million square feet. Martin Nussbaum, Principal of Slate Property Group, an owner, operator, and developer of residential and commercial real estate in New York metropolitan area that has purchased in excess of $1 billion in real estate assets over the last 5 years. Leor Siri, Chief Financial Officer of Silverstein Properties, a real estate development, investment, and management firm with more than 40 million square feet of office, residential, hotel, and retail properties, including the New World Trade Center. Joining us, I believe shortly, will be Robyn Sorid, co-founder and managing principal of G4 Capital, a middle market real estate bridge lending group founded in 2005 that has originated and funded loans with combined value of almost $1 billion. And Peter Sotoloff, I hope I got that right. Sotoloff serves as the managing partner and chief investment officer of Mack Real Estate Group, specializing in domestic and international real estate investment, development, and finance opportunities. Again, thank you for joining us. And now it's my pleasure to introduce our moderator and close friend, Michael Stoller. Michael is the president of New York Real Estate TV, LLC, and host and executive producer of the Stoller Report, New York Business Report, now in its 18th season. He is also the host of Building New York, New York Life Stories, Never Stop.
They don't want to hear this.
Never Stop. I got one more line, which is celebrated its 14th. He tried to do this last time also. Delighted to have you, Michael.
Thank you. Since there's so many things taking place in the real estate market, last week when I was on the phone with the panelists for a brief minute, I said, we got to talk about other things in addition to financing. That's one. Financing is very important, but we also have to talk about a little bit about the Amazon effect of what's happening as they see it, and also the discussion on opportunity zones. So this is going to be more enhanced than you think, not only on alternative financing. Let's look at what we have. Fred basically told you certain things about the people, but not enough. Okay, in addition, I'm sorry. As most people know, I can't wear a jacket, okay? It's inappropriate. Robyn's here.
Hi, I'm sorry.
No problem. We made the introduction. So what do we have over here? We have lenders and we also have developers, okay? You heard about Martin, but you only think that he's in the development business. But Martin, what have you recently done with what's happening that you started earlier this year in the financing business in Carlisle? So tell us a little bit about what you're doing on that.
Sure. So beginning of this year, we decided to get into the debt space, and over the last 9 months or so, we've originated about $250 million of bridge construction land loans. And recently, over the last 60 days, we finalized a partnership with the Carlisle Group, specifically on the debt side of their business, which gives us the flexibility to originate just under about $1 billion worth of loans. So we're hopeful that will work out well for us, and we're actively pursuing new deals and hopefully closing our first deal with that venture in the next week or so.
So since you're closing that deal, why don't we talk about what you're doing, what kind of deal it is, what kind of pricing it is, what's the risk reward? Now the world's changing with HFE, CRE rules being lightened.
Sure. So the loan that we're closing is approximately a $50 million construction loan in Brooklyn for ground up rental. The pricing on the loan is about 700 over LIBOR. And I think where we have been able to get a little more aggressive is on the proceeds side of the construction loan. What we have seen on the equity side of the business is that traditional lenders have cut back pretty significantly on loan to cost and loan to value, which has opened up a pretty interesting opportunity for a lot of mezz players, preferred equity, and shops like us now, where we're originating the whole loan, where we play in sort of the 70 to 80% of cost or value space, as opposed to the senior lenders who are somewhere between 55 to 65%.
How high are you going in the capital stack?
75%.
Okay, are you allowing mezz to go on top of the
No,
75%?
no. So our business plan is that we are the senior lender. There's no mezz allowed beyond the money that we have in the deal. And we're really focused on assets that we feel very comfortable about the locations. I think one of the benefits of the partnership with Carlyle is that we often have either bid on the deals that we're lending on. We have property around the corner, so I feel like we have real-time data on a lot of the deals that we're looking at today that get us really comfortable about where we can get to in terms of proceeds.
So is it a rental or a condo?
This is going to be a rental.
Okay, with a 30% affordable component?
Yeah, that is correct.
Okay, Mike, your RXR is the truly, as I would say, the 850-pound gorilla. They used to be 800, but they grow each and every day. So you're into everything. Let's talk a little bit about your lending platform, because you recently lent in Brooklyn on Gary Barnett's project in downtown Brooklyn and other large projects, $450 million or so.
Yeah, so our lending platform is really an extension of our equity fund business, and what we do is with each of our funds we allocate a portion of each fund to a different segment or product. And over the years, one of those segments has been lending. So it's been more a relationship type situation where we look at a particular investment from an equity standpoint, but in say a particular situation, there's more of a debt opportunity for us, and so we'd follow into that type of investment. And then over the last few years, as the cycle on the equity side, and particularly New York's investment side, has gotten late in terms of value and where the bid-ask is on the investment sales side, we've allocated a little bit more money into the debt space, and we formed a sidecar debt vehicle to our equity fund. And we put out about $350 million so far in 2018. And then as a result of that success, we're raising $1 billion fund. We had a lead institutional investor that put $250 million in the first vehicle, and now they're putting $500 million in the second vehicle, and we're raising the incremental 500 by our LPs and our equity funds and some new investors. So we're a little bit of a different lender in terms of we consider ourselves a value add lender, and what I mean by that is while we're more relationship focused in who we lend to, we also provide additional services to our potential borrowers. For just by way of example, one of the deals we did this year was lending on a project that is a St. Regis flagged condominium community in Rye, New York. It's the first of its kind in the area. And we have developed and are continuing to develop a Ritz-Carlton flagged condominium community on Long Island that we've had a significant amount of success with. And when we met the borrower in Westchester, and sat down with them, and they saw the benefits of working with us and we providing debt capital to them, but also realizing some of the synergies of learning that project, it being a first for them, and being able to leverage off our experience from our Ritz project in terms of site plans and designs and unit distributions and marketing and so forth. They saw a big benefit for that. And for us, it results in a pricing premium to the investment because we give that benefit for free.
Now, how high did you go in the capital stack on that?
We're probably about 75% there.
And
But we generally are open to going higher, again, because we underwrite our debt investments as equity investments, and obviously we have such a significant development platform that we get comfortable.
Now, is this for sale?
This is for sale.
So this is a
For
for sale.
sale.
okay, as opposed to a regular hotel.
Yeah, not
With
hotel.
regard to that, let's talk about Robyn. You've done some hotel financing.
I haven't. Good morning, I'm Robyn Sorid from G4 Capital.
So let's talk about your financing platform, what you've done, the hotels. I know you've done something in Williamsburg and other
Sure.
markets.
And we've been in the space pre-credit crisis and obviously have stayed in place. Our business started in 2005 really as a traditional hard money business. As a traditional hard money business and transitioned into an alternative credit post-credit crisis. Where the opportunity has been for us in the last several years has been in condos when banks really moved away from condo financing, and certain hotels, really all in New York. What Michael's referring to is non-flag hospitality financing, which we've seen an increase in demand in. We had one hotel property in Williamsburg, which we exited, which was the Williamsburg Hotel. We have another project in downtown Manhattan, which we're not allowed to talk about at this time, but it's another non-flagged hotel. There's really very little capital in the market for that kind of asset in the $50 to $100 million range, and we're seeing a lot of opportunity.
Speaking of that, Leor is the CFO of Silverstein, but Silverstein has a couple of things, and one of the major things that Leor recently handled was the Israeli bond financing. You want to explain how you used it? It was also oversubscribed, the transaction, and the pricing, I think, was in the low threes.
339.
330. I'm pretty good in research.
Very,
Okay.
very impressive.
So tell us about why you went to the Israeli bond market and where you see that as an opportunity.
Well, I think the rate speaks for itself in terms of why I went to the Israeli market. It was exactly a year ago when the company decided that this was a market that we wanted to enter into. Many other real estate companies entered into the market before us, but we felt now was the right time to, after doing our due diligence and understanding the Israeli market and the mechanics, we felt that at going in and contributing certain assets into this special BVI would be an interesting avenue to help us with liquidity purposes and additional acquisitions going forward. The process is very intense. It's basically like going public when you're having your debt being traded on the Israeli Tel Aviv Stock Exchange. We started the process in November of last year. We filed our paperwork with the ISA, which is the Israeli Securities Authorities, at the end of February 28th. And then similar to an IPO, you do a roadshow, you go throughout the pension funds, institutional investors, insurance companies, and you start to market yourself, basically. There's an offering at the end, and as a result of that, and based on our ratios and in addition to that, there's also a function of getting the bonds rated, which is a very important process as well these days. We were rated a AA based on the quality of the assets that we contributed, as well as the loan-to-value ratios, and that contributed to the low rate that we're enjoying right now.
Why don't we tell the group what assets you put into the package?
We probably
It's all
put in-
public information.
Yeah,
so-
it is public information. So some of the assets we put into were 529 Fifth, 1177, two of our residential towers, as well as 120 Wall and 120 Broadway. A small part of our portfolio. We were trying this to see how it works. Obviously, dealing with the Israeli markets is something new to us. We're not really customary to it. You know, there's a different culture. There's a language barrier. You are dealing with the Middle East as well, a country located in the Middle East. So there are a lot of parameters, and we just wanted to dip our feet into the water and see what it's all about. There's also obviously an FX exposure. When the debt is issued in Israeli shekel, you're exposed to foreign currency translation adjustments as well. That said, we wanted to see what it's all about. We are familiar that many other real estate companies have been a lot more active than we have, but as many people know in this room, we are extremely conservative and do things very slowly and methodically and make sure we analyze.
So here's the point. This conservative company is now going into Silverstein Capital Partners. So tell us about,
Sure.
and you hired one of the best guys, Michael May,
Absolutely.
to run this thing.
So
cancer.
similar to what I'm hearing here on the panel and what we're seeing. Most recently, we closed on a finance vehicle with a pension fund, as well as a insurance company. And we are looking at, I think one of the skill sets that
New
we
competitors for everybody sitting
Yeah.
at the table.
but I think what differentiates us from other companies, I believe at least, is we're looking for complex, large projects. And we do have the manpower in-house. And we're able to move rather quickly, given our history with large projects, complex projects. Clearly, the towers that were recently built, the Orlando project that we built down at Four Seasons in Orlando. That said, we think that we can move a little quicker than other companies or traditional lenders, and we think this is the right time to go into this avenue.
We're going back to you in a minute, but Peter, you're a pretty active lender, also a developer on the other side of the hat, with Richard, and you've been involved with hospitality and also Philadelphia and other things. Why don't you talk about what Mack Real Estate Strategies and what Claros is also?
Sure. Appreciate that. So for many of you who don't know, we founded a lending business about 5 years ago, all institutionally capitalized, taking advantage of many of the factors that Michael and Martin mentioned. We do generally about $6 to $7 billion of originations a year, large projects generally, but with relationship borrowers, many of whom are repeat, including Martin. We will do some smaller projects as well. It's focused in major markets. Michael Stoller mentioned Philly. We've obviously got 3 or 4 loans there today. We're about to upsize one of those loans. But the reality is we pride ourselves on obviously not competing against our borrowers. On the equity side, we're not in funds. We generally co-GP deals. We've been very conservative. We haven't bought really a piece of dirt in the last 3 years, just given values. But we look at the lending business as an extension of our infrastructure and knowledge and the ability to help borrowers realize their projects when things change, obviously, in development and heavy transitional. The only kind of mantras are it takes longer, costs more, and so we're very active in being responsive to our borrowers, unlike a lot of the banks and insurance companies, but we do partner with a lot of them, given obviously the HVC area that Michael mentioned and other regulations, and just generally a risk aversion to anything that's not cash flowing. So that's important. About 30%, it's going down to about 24 of our book is hospitality. We're about to sign up a very large loan, again, in New York City, about $400 million. We've lent on the Manhattan Times Square recently, along with 2 St. Regis assets in DC and Bell Harbor down in Florida. But we're very much about basis. We're very much about institutional sponsorship and scale and size. And that's really what
Martin
does.
spoke before about his pricing, that he's doing a deal at like 700 over. What's your pricing normally in the deal, and how high in the stack do you go?
Confidentially, we just signed up a deal for Brookfield, office in New York City, 200s over pricing. So
Why have I not seen that pricing from you?
I was going to say
He
that
always
because
says to me, you can't do
because
anything less than
I knew-
350. It's
you
never
see,
less than
Martin, I knew
350.
that you borrowed from
I was
him.
waiting for this moment. This is perfect.
It was a great lead. I figured that's why we put the two of you separate.
Amazing.
Okay, but here's an interesting discussion. Mike, you're so active in so many areas. How come you haven't touched the Israeli bond financing market?
We looked at it. We were a public company for many years, and now we're on the better side of things. So we have a little bit of aversion to stepping back into that, and we've been lucky enough to access capital in a lot of different forms. We actually issued bonds in the private market at sub 5% with the insurance companies in the U.S. And we, as I said, we've gone down the road a couple times because, like Silverstein, we are a good candidate for that type of financing. We have the infrastructure in place to deal with it. We've been a public company. I think that I don't know about Silverstein's case particularly, but there's some other costs besides the rate that sometimes could ratchet up pricing there. But as I said, we've gone down the road a little bit, but never wanted to step back into that the public reporting requirement.
Here's a point, for Leor and you and other people. When Joe Moynihan raised money on the Israeli bond market about 2 years ago, he took some of the money to be used in the lending business, okay?
Yeah,
Peter?
look, we get approached, given our large family portfolio, select institutional investors on the equity side. All of those same advisors came in to us, and I think philosophically we have an issue with we're obviously very supportive of Israel and is a big ally of the U.S. But we thought that the structure, in terms of creditor protections for the pensioners and insurance companies who come into the Israeli bond structure, not only is it mispriced, it's misstructured. You can apply priming debt. The bond holders have no rights or real security or ability to enforce that. And you can see on some of the non-quality borrowers, like non-Silverstein borrowers, I would say some of these are trading at very, very wide discounts because the borrowers have not hit their performance requirements, and their investors in those bonds are stuck. And one of the arguments we made when we came in and pitched was, we can give you a product. We do have, we're lucky to have a bunch of Israeli large institutional investors, but one of the arguments we made was, you can come into our product and get comparable yields at lower bases in real estate with real structure and institutional management. And you can see, obviously, not speaking for the quality that Silverstein is, who's a very high quality firm, but you can see now the writing on the wall of what's going to happen to a lot of the bondholders and buyers of these securities, given the lack of protections, lack of security. And it's unfortunately, in EB5 is another example of some of the pitfalls out there that people are going to learn the hard way about.
And just speaking to the bond market, we saw assets that had no pledge obligations in our documents being financed on the market. We spoke with the advisors, and they said that there were ways around it, but there were direct prohibitions in our documents, and these assets were actually part of a larger offering. They said it's a corporate structure, it's actually not the same entity, but it was really a run around assets that we had complete control over. So,
Where do you raise your money institutionally?
our investors are all family offices. We've never done a true third-party raise. We are going out to the market for a new fund where we will have an institutional investor base, but our bread and butter has always been family offices. Initially, really high net worth investors, and then family offices. As family offices have come into this space, we've been more concerned about some of those underlying investors taking more significant pieces of our business as they set up their own internal shops, but it's always been a family office investor.
With regard to that, how many new players, have you seen recently enter the market? Martin, since you're playing active now with Carlisle and the other things.
Again, I clearly I'm new, so I'm not sure if I'm the perfect person to ask the question, but I mean, there's a lot of competition. What I can tell you is that there's a tremendous amount of competition that we're seeing on anything that we're actively leaning into. And
so when competition is there and all of you lenders are basically semi-conservative, as Robyn alluded before, she was a hard money lender. We didn't call anybody hard money lender.
I was. So that was
right,
pre-credit crisis. We all had a.
Okay, so we were hard money lender. What type of assets does the group like today? Okay, there's the question, there's the perception, with the tax law changes that condos may have difficulties. Okay, Mike, you've made a big commitment in condos, but the major condo that you did in downtown Brooklyn has one great thing: a 21-year tax abatement. So that's taking away certain effects. How do you look at the condo market as a lender? Robyn, Mike, and...
Sure. I think we all like to say at this point in the credit cycle, we're being more careful, we're picking the best sponsors, but we still have to do business. And so how do we do that? We find opportunities where there's special situations. I think that's what our group tries to focus on. We do allow a mezz. I've heard here on the panel that some folks don't. For us, we think sometimes mezz can be interesting credit support for our borrowers. So as long as it's structured appropriately, we look at them as credit support. So that's one way of finding business that certainly banks may not be open to and other lenders. We're also opportunistic. If we think everyone is looking at condos in a certain way, we'll take a nuanced look, but we certainly won't not do condos. There's a number of condo projects downtown where I live and know that submarket that I think are still interesting. And for us, it's a basis play. We're also finding interesting opportunities in hospitality. We're 100% laser focused on the New York City market, so we're not looking in secondary markets. For us, seeing what happened post-credit crisis, that market rebounded more quickly than other markets, so we're willing to be more opportunistic. We'll go to the 70-75%. And another way that we're winning deals, which is really what we feel like sometimes when we see 5 shops competing for the same deals, is we'll help bring in one-stop shop. So we'll bring in a mezz player where we have a negotiated intercreditor. So while we're not providing that last dollar, we give them certainty of close and lower transaction costs.
Mike?
Yeah, I mean, we look at things more broadly in terms of New York City and the surrounding market, and we're very bullish, on New York. And it's interesting. And I'm sure Silverstein has the same outlook. Is that when we look at what's happening in our office portfolio and expansion of our tenant base, and obviously with 20 million feet in Manhattan, we have exposure to pretty much every tenant in the marketplace, whether it be banks or the Googles of the world and so forth. So we continue to see expansion. You heard, Friedman is expanding, and that's happening all over. You mentioned Amazon, and that's just a whole nother level, I think, which while you hear some hiccups of how it's being structured and some of the credits on the tax credits, I mean, that's a good thing over the long term, and I think they're just going to continue to grow as all technologies in Manhattan, and it just gives another layer of proof that technology industry is coming into Manhattan, and it's going to come into Manhattan and New York City in a big way, right? So as that as a backdrop, we continue to be very bullish on Manhattan in the interim and particularly in the long term. So when we look at lending money, we look at it in that context, but then bringing it down a few levels. Again, like Robyn said, we look at sponsorship. That's obviously a big thing. We underwrite all our loans as if we were investing equity. So we have to be comfortable with location and submarket and what's going on and what the dynamics are. And given our office portfolio, that gives us a lot of insights as what's going on in each of the submarkets. So, and as far as competition, I mean, this is such a massive market. We're here. We represent, I don't know, whatever, $10 billion, $20 billion of potential lending. That's not that much in this market, so everybody has their fingerprints on something to get done, and while we're competitive, there's more than enough activity that's good projects and good sponsors, and if you're smart, you'll do well.
Here's something I noticed that Peter just recently did. You did a deal down in the Village with 100% WeWork as a tenant. Certain people, and I recently, 2 days ago, did a show on co-working. I also had Silver Suites on, who was in the office sharing business, and I had Industrious, which is a management company. How do you look today at lending to the co-working world, okay? The WeWork, the Yard, the Industrious, the Virgo offices, the car. I mean, because that's your credit over there.
Yeah. Look, we...
with lots of competition.
Yeah, we this was actually a refi of a small deal. We did an upsize, but we look at the world as real estate equity first, and in the particular Village situation, this is an L-shaped building, good light and air. We're at a lending basis that if, God forbid, there was ever a failure, and I know every other quarter they seem to attract more capital at higher valuations. But if God forbid there ever would be a hiccup in the co-working space or WeWork in particular, we felt at a basis it worked as an alternative office or it's as of right residential. But much to our conservatism as a lender, which you have to have, they came in and subleased it to the IBM enterprise division, so it's really 700 people signed up, 800.
Right, it's under the enterprise, I suppose. But here's the question for the other people: how do you look at the co-working share space, Mike? You know it too well because years ago you owned one of the companies.
Yeah, we did in a different era. But I think answering the question as an office owner in Manhattan is that we believe it's a industry that's here to stay. And we're approaching it as a couple of ways in terms of them being an amenity to our building and a partner. And we're embracing them, and I think I don't know if it's going to be 5% of the market or eventually 30% of the market, but I think it'll be part of the market, and it could be, a significant part of the market. So in terms of their credit, it's hard to say right now. WeWork has a huge amount of cash on their balance sheet, and they have significant investment behind them. I would suggest that they're a little bit over their skis in terms of how much they're accelerating their leasing of space, but I think it's a real business. I think the business is going to stay. I think it's going to evolve. I think office space and office buildings are involved to be a more multi-serviced environment, and they provide a service, and I think over time you'll see more and more owners of office space partnering with the co-working and WeWorks of the world, and there may be some consolidation in their business, like everything else, but I think it's a business that's here to stay, and it's structured differently than when we owned 88 centers in 17 countries, and that was more of an acquisition game, and this is more a strategically placed game. So I feel good that them as a tenant and in our buildings and as a industry in general.
Okay, Leor, you have Silver Suites.
Sure.
How does Silver Suites operate?
Right, so we look at Silver Suites a little differently than WeWork. We kind of consider Silver Suites as like the four seasons of sharing office space. Meaning we're very selective with the tenants that or the co-working environment that comes in. I mean, the caliber of the space and the quality of the space is very different than WeWork. Similar to what Mike mentioned before, we look at it as an amenity to the World Trade Center site. And what usually is happening, what we've been experiencing, is these tenants who are able to come in and pay the rent are eventually expanding and growing. And what helps us is they eventually come and take a full floor, 2 floors eventually at Tower 3 and Tower 4. So that's our perspective on Silver Suites. A little different than the WeWork environment. We are entertaining WeWork in some of our buildings.
But you know what? As I said, there are other players over there, and so if we have another player, and for example, Mike has made an investment in Convene, okay, who's basically a management company, who's running basically a hospitality company, which is similar to a Hyatt brand type of thing. How do you, as lenders, Peter, Robyn, and Martin, look at a co-working and a management contract as a different type of thing? Because it's not a long-term lease; it's a different type of market over there. Peter?
Yeah, I mean, as I said,
the village, as you said, was a unique experience.
Yeah.
The building could be used for other purposes, so you had an end game. Okay?
Yeah, look, we're cautiously optimistic, but I would say, given our job as lenders is to protect the downside, we generally are looking at if a company or concept fails, could we release or re-rent or repurpose that real estate at our basis in some other way, and what kind of, generally there's higher TIs, higher improvements in that space, what would be the alternative solutions for that? Because it is an unproven concept, not to say that it isn't something that is changing in the way people use office space more efficiently and productively. Companies are obviously catching on to that, so we're cautiously optimistic. But as lender, we're also looking at what are the other alternatives. And if I look across our entire portfolio, I would say we really have only 2 true exposures, including the one Michael mentioned, to a co-working type tenant, and in both of those situations, one we went through, but the second one, they are paying what we believe is an above market rent, and so we marked that rent to market, and we thought about who else might utilize that space in the event that a company like a WeWork or others were to fail.
Robyn?
To Peter's point, we find that the co-working spaces are often above market in terms of the rent, at least where we see it going from this year forward. We had to kill a deal because we just couldn't make the numbers work, and our potential borrower didn't want to put in additional equity. I think for us, we're also seeing a unique opportunity in boutique office. I think the office market is evolving generally, and there's a lack of interesting new office space downtown, not necessarily only in the corridors that are already expanding, but on Park Row, in certain parts of the meatpacking. And so for us, that's our opportunity to be in office. In the co-working space, we just don't believe in the credit enough to be as competitive as other people are.
Martin, what would you, since you haven't done any, would you?
It's just not an asset class that we are going to be lending on, period.
Okay, you know, we were talking about above-market rents. And another area today, which I've recently discussed on my shows, is the co-living, okay? Where people are getting above-market rents and people are looking for higher financings over there. Okay, you know, the apartment basically, I think a good example would be the building that Ollie is taking care of in Long Island City, where they have co-sharing spaces, and those rents are significantly higher than a one-bedroom or a two-bedroom. How would you today, all of you, as lenders, look at those type of opportunities? And where are you interested in lending, first of all, to those opportunities? And at what dollar value, okay, would you be interested? Robyn?
We just looked at another co-living deal. I think we sound incredibly conservative, I guess, as a bridge lender, but where the market is being creative, we have to
That's why your investors get their money back.
Yes, return of capital. We have found that at least the co-living projects we've looked at, the rents were so above market of where we'd have to land if we repositioned that we haven't been able to go forward on them.
Martin?
Yeah.
Since you may be in the co-living business yourself one day.
So we have actually had one of the co-living operators in one of our apartment buildings. So we have hands-on experience of actually seeing how they operate, how they're doing, and they are paying over what the market rate would be for other apartments in this immediate area, because we have a building next door to it that is not doesn't have a co-living environment. And what I can tell you is that based off of what I'm seeing in that space, I don't think it's that sustainable. I don't, for the pricing that they're trying to upcharge a person and the price point that they're trying to get someone to enter into an apartment, they're really looking for transient type of tenancy or people who can't
But
really.
now I'll talk to you as the borrower, okay, as an owner. But I have 3 people on the lease now. You know, I've done a lot of credit, you know. People like that. I don't have to bring in, all I have to bring in is my toothbrush, you know?
I understand it all, but I think I've been fortunate enough to see what the outcome of that all is, and the outcome of that is that their occupancy is much lower than our building next door, and they're trying to go after the same tenant that I'm going after for 10, 15% more, and quite frankly, that tenant is paying as much as they possibly can for that apartment, and upcharging them because they have a wine and cheese once a week, to me, doesn't really add up.
And Michael, just to one further point on that, you're really investing in a business at that point, not in real estate. It's not different than making a bet on an F&B component. I think if you're really thinking about the bricks and not whether this business model works, then you're.
But you bring up a great point. You know, when you get projections today for a new hotel, people are projecting a lot of money on the F&B area, and that's totally risk capital. You have no idea.
Right. So, I mean, that's why the hotels we're most focused on are ones where the F&B component isn't a disproportionate amount of the revenue. There's a great deal in Miami. I think a lot of people saw probably on this panel. The F&B was such a big component of that revenue story that it couldn't get done, even though that F&B was so successful, because if it went out next year, that hotel just didn't work. So I think you have to make a choice if you're investing in a business or investing in real estate.
Peter, what's your thoughts about the co-living?
Look,
It wouldn't have ever taken place at Blackstone, I know
Yeah,
that.
right, I know.
But they're going into the co-working space.
So that's a longer story. But the idea is if you're going into a co-living space and you have all other alternatives where landlords are cutting rents and giving concessions and you can have your own space, you're not living in a co-living. Who wants to live in a frat house? So I just think sorority house. I just fundamentally believe that if someone has alternative choices, they're taking them no matter, as Martin said, how many wine and cheese parties or social get-togethers there are.
How, one area that we haven't spoken about, and everybody, there's changes. Rebney just came out with a report that rents were down 24% in certain markets. Retail. How do you, as lenders, look at the retail world? Who wants to? Mike?
Peter, you take that.
I'm getting nominated by my fellow panelists. We on the family side many years ago made a large investment in Hudson Bay. It was a very successful investment, about 20 times our capital. But what we were able to do, and through that, is see the challenges ahead of time in real estate. So we've been very negative, even before it was water cooler talk, on just what's happening in the retail space and online and deterioration. And what I think that's directed our lending portfolio is we have virtually no retail exposure. The exception to that is deals we've done like 20 Times Square, 1568 Broadway, various other sites in the major cities where there is a retail component, but it's generally pre-leased on a long-term basis in well-trafficked areas, and the success of that retail is not a critical component to the overall recovery of our loan principal.
Yeah, we're not doing anything on the lending side, but I'll tell you on the equity side, we are looking at opportunities for looking at retail companies, retail REITs that are trading at significant discounts to NAV. And when you dive into a number of these companies, they have real estate that can be repositioned. And some of these companies have really good located assets that need to be transformed out of big box retail into mixed use, including residential. And the problem they have as a public company, they're not allowed, or they really are prohibited from doing that because of dilution issues and other issues as being a public company. So we've been looking and speaking to a number of these companies where we could potentially do a transaction and then help them transform their projects into more mixed use, dialing back the retail out of big box, adding in residential, and having more experiential retail combining into the mixed use. So there's a couple of situations we're looking at, but that's really on the equity side.
Martin?
Yeah, I want to share a little bit more of an optimistic viewpoint on the retail, at least for the projects that we are involved in on the equity side, and which is allowing us to look at the debt side a little bit differently. If you're willing to take your pain on what you underwrote versus what the realities are of the retail market, you can lease up your space. Whereas a year and a half ago, I would not have made that comment. There are certain spots where we have said it's unachievable to hit the underwriting that we had sort of hoped we were going to be hitting on certain aspects of the retail components. Now, fortunately for us, our equity portfolio is 90+% residential, so we're able to take the hits on the retail side. But we decided about 6 months ago to cut our rents to where the market was going to move and rent up our spaces. And since we've done that, we've rented up probably 80% of our vacant space.
And what type of tenants?
I'm not going to share with you the discounts that we have to take to get there.
I'm not asking the discount, but what type of tenancy have you put in?
I'm talking about national tenants. I'm talking about small tenants. I'm not just talking about your restaurants and bars and coffee shops. I'm talking about banks. We're talking about real type of tenancy where at the right number, they're coming and they're signing long-term leases, and we're not having to give away huge TIs. Like when you're comfortable clearing the market at the right rental rate, you're able to clear the market, which I think is interesting because it's allowed us to look at the debt side a lot more aggressively than maybe some other people.
I wanted, as I said, we're talking about other topics, and one topic which I think is called the opportunity zone should be changed. The term was the opportunity zone, the tax law effect to help the accountants, lawyers, and consultants. Bill, okay? What's your thoughts? And I know, Mike, you and I were on a panel. We did a show recently. Let's talk about where you see the opportunity zones and who's going to invest. Is it the real estate families or is it the individuals?
Well, it's pretty so far a wide open program that's going on. It's getting geared up, but I think it could be quite substantial. I mean, there's said to be $6 trillion of capital gains in the market right now. And so the opportunity
Went up yesterday because of the 600 points.
Yeah, 6 trillion, I said. So the opportunity, I think, is massive. We have been developing in these opportunity zones for the last 10 years or so, and about 5 years ago, we formed what we called an emerging submarket fund, and we raised $300 million to invest in what have now been designated these opportunity zones. The tax benefits of investing are really quite extraordinary. I don't want to go too deep into, but essentially you can defer capital gains, and it's not only capital gains from real estate, it's capital gains from anything that qualifies as a capital gain for federal tax purposes. So it's stocks, it's bonds, it's art, it's your business. It's anything that you generate a capital gain, and then you can defer that gain for 7 years. After 7 years, 15% of the gain is eliminated. After 10 years, not only is the 15% eliminated, but any profit on the gain that you invest is eliminated.
Thought you weren't going into detail.
Right. So, so it's really quite extraordinary, and we're working to get into the game. And as I said, since we've been in it, we have a pipeline of over $1 billion of projects that are in these zones. So we're going to be a very, very active member, and we're going to probably be out of the gate pretty quickly on this.
Robyn, Peter, anyone else?
We've been watching more from the stands, but I think for us, what's interesting is watching the brokerage community really respond to this and reach out to the fee owners and to see whether that bid ask is going just to get too wide right now, to not necessarily for the opportunity to be as compelling as folks might have thought. We've had a couple of, in our family office portfolio, we have a couple of properties that would fall within the zone, and the numbers that we're being told to seek are just outside of where we think the market is right now. So I think it's exciting. We'll all see where that goes, but I'm not sure that the value yet can be realized.
Peter?
Yeah, I can't really comment on in a lot of detail, but many of our equity projects are in op zones, and we are very big proponents, of. I think that it's a very useful tool. These tax changes that have been made, in terms of it was really geared towards tech entrepreneurs out west, is frankly where it generated from. But many people have appreciated securities that they want to defer taxes on, and it's a good way of obviously revitalizing underserved areas. Although many op zones, if you notice, aren't exactly in underserved areas. But it's something that you'll see more about, and is something we are very big proponents of.
Here's a question as lenders and owners who are going into properties. The owners of rent-stabilized apartment buildings are under siege today. Changes in government changes over there. And certain people, and I recently spoke to a number of investment sales brokers saying that sales are down. A lot of people don't want to touch anything that has rent-stabilized apartments. How do you see that as investor, Martin, and the other people, and as a lender with more government regulation on the MCI possibly leaving, the 2700 leaving, and so on? Martin?
So it's a very difficult question, because the reality is I don't think anyone has any answers today about what we're going to be at the end of June. So I personally think that for pure rent-stabilized purchases, lending, we are going to be sitting on the sidelines and waiting to see where things fall. We own north of 1,500 apartments that are going to be falling into this category of rent stabilization, preference, increases, rollbacks, all the kinds of things that, quite frankly, keep me up in the middle of the night. But I think that the pure rent-stabilized game of buying an old rent-stabilized building and hoping you're going to vacate apartments is on a complete lockdown for right now.
So here's the question, because all of you are value-add lenders and who've lent money to people who've bought these apartments, bought out apartments, changed the configuration. How do you see yourself lending in that environment? Robyn?
Well,
Peter?
we've been very cautious. We haven't been lending on rent stabilized.
Yeah, we've been cautious, but I think the exercise you have to do is assume the worst as a lender in terms of what, whether it's the borrower claiming, they're going to continue their MCI, activities, or the natural, vacancy adjustments, that you just got to pretend that does not continue to exist as it has in today's form.
I think the bigger risk around what could become an issue for us isn't so much $2,700 or $5,000 to deregulate an apartment, or if it's 1/40th of the dollars you spend. I don't think that's, because eventually there's going to be a formula around that, and we'll live with the formula. Everyone will adjust their underwriting, you'll adjust your pricing. I think the real risk here is what happens with preference, because a lot of us have apartments that we're renting for $3,000. I have a maximum rent. I can maybe even push it to $5,000. And if they roll that back to $3,000 and stabilize those apartments at that number, that's a game changer for what most people would consider a fair market building becoming a pure rent stabilized building. And I think there's gonna be a lot of pushback from owners like myself and Rebney, and I think that's gonna be a heavy pushback from our side. The rest of it's a little bit of just adjusting sort of how you underwrite deals going forward.
One last question, and then we're going to have our tax person, and then John and I are going to go. Amazon effect. How do you see that with regard to the city, in Long Island City, with regard to lending market, buying market, and so on? Who wants? And Mike, I think you have a industrial building in Long Island City specifically.
Yeah, I mean, listen, I can't see how Amazon coming to New York City is a bad thing. I think they're going to come. I think they're going to continue to expand. I think there'll be ancillary businesses that grow around them. And I think they made a very conscious decision, and I think long term it's going to be very good for New York. So I think it's all positive. I think it'll grow from Long Island City. I think parts of Brooklyn will benefit. I think even the suburbs can benefit from the Amazon effect. I think potentially it'll shift somewhat is now heavily focused west side movement of office property potentially to the east side. And when east side access opens up, that'll be helpful too. So that potentially could create some rebalancing of location from the office standpoint. But I think it's a terrific thing.
And I'll talk about it with John. As somebody said to me the other day, when they're all development, you're going to see people moving to Coney Island and to other areas, even though they may be a little inconvenient, but you're going to have to take care of the employees and everything else, the additional people moving in. Anyone else want to?
Yeah, we bought a development site in Dutch Kills, which is kind of Long Island City, Astoria area, about a year ago. It's 250,000 square feet that we are going to be building a residential building. And what I can tell you is the Amazon effect to that specific property has been multiple calls asking us to sell our property for significantly more than we paid for it. I could tell you
that, and then you can put the money in an opportunity zone.
And it happens to be in an opportunity zone also. So to your question about opportunity zones, we get called all the time now to see if we'd recap out our existing partners with some opportunity zone type of money, which I think is very interesting. So I agree with it. The Amazon effect can only be positive to real estate in every way.
I concur.
We've gotten a few calls for projects that were dying a slow death, and then post-announcement, they came back, and there's at least activity around these projects. I think it's TBD what the effect will be. Obviously, it's going to be positive, but certainly it's helping people get off the ground where they otherwise might not.
Okay, any questions for the group before we? I'd like to thank everybody. Thank you for a very interesting panel. As you could read in the program, John Catsimatidis is I'll call him exactly what he is, an interesting character. John and I have known each other, I don't want to say, but it happens to be over 30 years. I met John when he was, we were members of the Young Men's Philanthropic League, and I still remember, I said, John, how were you in the jewelry business? During his interesting life, he talks about some of his careers, but he omitted the fact that he was in the jewelry business, and the casting business, and a variety of other businesses. So, John started with supermarkets when you were at 18? 18? Started with the supermarket business at 17 or 18?
About 18 years old. I was a junior in NYU.
And what happened?
Well, I was working part-time in a grocery store. And I had no brothers or sisters, so the guy I was working for was almost like a big brother. I never said no to him. So I was working hard in school. NYU Uptown campus, when NYU had an Uptown campus, it was a great campus. And I used to work for him on summers and on weekends. And he had an uncle that he argued with every day. And he just couldn't take it anymore. So he finally said to me, why don't you take my half of the store with my uncle? You argue with him. So he gave me his half of the store for $10,000, $1,000 a month for 10 months. I had no idea if I could pay $1,000 a month in 10 months. But I did it, and that was the beginning.
Now, you call the stores, what, 7-Eleven?
I called him Big Brother. I called him Cousin. He called it 7-Eleven because he figured he was going to block 7-Eleven from coming to New York because he owned the name.
He didn't win. So,
He didn't win.
so let's talk about how do you get involved with the real estate business? I mean, how do you make a decision about 35, 40 years ago to go from Myrtle Avenue, which is very hip and face great area, Pratt and everything over there, and how do you get into the real estate business and make a decision, Myrtle Avenue and other parts of it?
Well, I ended out, I'm in the retail business in 1968. This is my 50th year being in business, which is, I feel gray already. I better use some better go to a better barber. You can't be in the real estate business you can't be in the retail business without being in the real estate business. So when the world was coming to an end in the early 70s, I used the supermarket business to buy up as many real estate supermarket sites as possible. So I just kept buying, using the excess cash from the supermarket operation. The supermarket operation used to have excess cash.
Now, some of your properties today are owned by the CVS Aetna company, right? They're occupied by them.
We had sold them a lot of locations. Don't forget, when I wear my supermarket hat, I wear my supermarket hat. When I wear my real estate hat, I do what's best for the real estate company.
Okay, so let's go to, before we get to the real estate subject, how do you see the retail? You were here for certain of the comments about retail. How do you see retail? Bricks and mortar is not dead, but what's happening today in the retail business?
I think it's a new type of business. People have to learn how to survive in it. You have the internet business that has taken hold of retail. I had a gentleman in my office the other day that's a builder. He helped build the Amazon distribution facility in Staten Island. And I forget the number he used. Amazon was shipping out something like, it was either 8, forgive me, I'm probably wrong, it was either 8 million packages a week or something like that. But that's a lot of packages. That's a lot of demand. My kids, who are in the mid-20s, don't know what a magazine is. They don't even buy television sets anymore. But they know how to use their iPhone. They know how to call up and say, I want a glass of water in 2 hours. But it's crazy. That's what's happening. I read the other day that Walmart is starting a same-day delivery service in China. Now, where do the twains meet? I was, my radio show. That's my new hobby because I had nothing to do on Sunday mornings. I was bored. And I also have a radio show on Wednesdays between 5 and 6. And last night, I gave an example. I was in the airline business. We had the 11th largest airline in the country in 1984. Me and Carl Icahn were competing. He had TWA, I had Capital Airlines, and it was fun. It was fun till People's Express entered the market. And People's Express entered the market for some crazy numbers, $19 to Chicago, $49 to Miami, $69 to Puerto Rico. And everybody would scratch their head. And they'd say, how does that happen? How do you do it? And I would scratch my head and I said, we can't put enough fuel on the airplane to run the airplane for $69. So I'm going to say the same thing. And what People's Express was the biggest fraud that was going on in that period of time. And they were cooking the books. They were showing gigantic sales. The sales were going like this. Wall Street was throwing money at them with both fists. And then one day, you say, oops, our accounting is wrong. The oops effect. Well, I look at Amazon, and they're getting so big, so fast, and you wonder how they can do some of the things they do. I don't want to be a naysayer. The model will work. The airlines work, other than People's Express. But is Amazon really doing what everybody thinks they are doing? How can you deliver this to my son in 2 hours for $2 or whatever?
Got a question for you. You're in the quick service business also. In addition to owning the Gristidis, and I also know I believe you have an interest in D'Agostino. You've kept them alive.
I didn't want to see D'Agostino die, and we wrote a check, and we bought them out, and we merged it. We completed the merger with Gristidis and D'Agostino on August 31, and hopefully it'll allow both companies to do a little bit better. What is it called? I'll give you some small numbers. The overhead for Gristidis was $5 million a year. The overhead for D'Agostino was $5 million a year. Guess what? 5 plus 5 equals 5. So we eliminated $5 million in overhead. We got some other efficiencies. So it allows. But I'll tell you what I tell them. Guys, we're no longer a supermarket business. We're no longer going to be the cheapest guy in town. We are in the convenience business. Your marketing area is within 3 blocks. If somebody wants to go downstairs from their apartment house and buy some milk and they don't know how to use the computer and they don't want to use Amazon, we're your customer.
How is the increase in the minimum wage, which has gone up over the last couple of years, had an effect on the supermarket business?
Horrific. And I did make a proposal to Dean Skelos before he got in trouble, and it was a great proposal. The proposal I made was that kids living at home, nobody can pay the rent on $8 an hour or $9 an hour. Well, you understand that. But young kids living at home, and they're 16 years old, 17 years old, 18 years old, the minimum wage should be a lot less. Now, if you're on your own and above, pick a number. It's all negotiation. 22 years old, 23, 24, 25, then you can go to $15 minimum wage. But it costs Gristidis, it costs D'Agostino 2% of sales. Now, let's go back to the old days. Don't forget, I'm in the business 50 years. So expenses go up 2%. For us, it goes up 2% for everybody else. So everybody goes up 2%. The consumer has to pay. And the $11, the $13, the $15 that's coming up in January, 2% each one of them. So 2 plus 2 plus 2. What happens? It doesn't only affect, first of all the supermarket chains are just about gone in New York City and Manhattan. It doesn't only affect us. What it doesn't do, it's now a bigger market than just our stores or just convenience stores or just supermarkets. It's the internet, which may or may not have the same costs that we do. So the retail costs, I'm also in the real estate business. Renting out commercial real estate is getting very, very hard. And
Who are you
D'Agostino?
renting? Who are the tenants that you're renting? Because you have locations in Brooklyn, you have locations in Manhattan. Who are the tenants today that you're renting to?
Well, there are restaurants that are willing to take a chance, but less people are willing to take a chance. The banks are holding steady. The supermarkets
You
are
failed
not.
to tell us that you were once a banker also, I remember.
I was chairman, CEO of First New York Bank. I was chairman of the executive committee, and the FDIC comes to me one day in 1990, remember those days, and says, you have to fire the chairman and CEO. I said, oh, okay. I fired him. What are you going to do? The FDIC tells you to fire him, you fire him. And there was 30 board members, and they say, okay, I got 29 votes that I become the CEO. It was an experience. In 1990s was an experience, and it was a great experience for me because I learned the business from both sides.
In that same vein, you just saw certain people on a panel who are private lenders over there. Has Red Apple Enterprises, John Catsimatidis operations gone into the lending business or the note business or the financing business also?
We are available to lend. Our investment company, which my son and daughter chair our investment committee, has, they're managing a little bit under $1 billion. And the choice is, where can you get the best return on investment with the least risk? So that's what it comes down. We invest in high-yield bonds. We invest in convertibles. We invest in equities. We invest in, by the way, 70% of our investments in equities are financial institutions, and we didn't have a great year on financial institutions. Financial institutions and energy. And it's interesting times what's happening in energy between President Trump and Saudi Arabia and Russia, because what you see in the last 60 days, oil going from $74 down to $49 this morning. Pardon my language, it's all bullshit. It's a game being played.
Aren't you in the gas station
international
business
market.
also?
We have a little over 400 gas stations. We supply most of the needs on Western New York, Western Pennsylvania, Eastern Long Island, or Eastern Ohio. And we have our oil refinery in Western Pennsylvania. And we get our shipments from Canada. We have our own pipeline that goes into Canada. We just built a second pipeline for $250 million in Canada to increase our supplies. But I'm going to give you a revelation that nobody knows in this room. Ready? WTI, which is normal crude oil, is $49, $50 a barrel this morning. Because Canada cannot ship out their products well enough, our company this morning is paying between $15 and $18 a barrel.
I know you're passing this through to the consumer.
Absolutely not.
Speaking,
You know, in the oil business, you have good years and you have bad years.
you know,
When you have good years, you have very good
so I have a
years.
question. We're going to get to Coney Island and some developments, but you know, you've been in the plane business, the jewelry business, 18,000 different. Have you ever gone into the hospitality business? Have you been in the hotel business?
We are building, you know, in diversification. There's one thing you'll learn about me, and you are the one person that knows because we've been together for a long time.
Right.
I've always constantly diversifying. My next diversification, and we were Florida, and don't forget, I was in Florida.
You were also in Dominican Republic doing business, okay? You know, and
Absolutely. We are part of our airline business. We used to fly to Puerto Plata.
And what about you were in the supermarket business also?
We owned the Grand Union in the Virgin Islands, the Grand Union Company. We owned the Pantry Pride Company in the Bahamas. We owned Pantry Pride supermarkets in Florida. We had all the supermarkets between Key West and Riviera Beach. And we bought those from Ron Perlman. Ron Perlman was closing Revlon at the time. And the deal was that they sold us all the Pantry Pride stores in Florida in 1985, 86. And it was financed by, remember that name, Chemical Bank? By Chemical Bank. And we got 47 stores and 40 shopping centers. So I was in the real estate business in Florida a long time ago. And we did, I would say, as usual, we did better in the real estate business than the supermarket business, but we made money in both.
So let's talk about, what is it, Ocean Shores?
But we're going back. We're going back to Florida.
Okay, let's talk about Coney Island with your trolley and the cabanas. What are you doing there in Coney Island?
We used some 1031 money years ago.
You're also, if you want, it's the Stoller Report this week, ironically, that John's on the show discussing this.
We used some 1031 money a few years ago, and we bought a lot of beachfront right on the ocean in Coney Island. And, you know, you go there and you look at it, and you know something? You fall in love. You go there when the sun is shining on a Saturday morning, and you look at the ocean, and you say, wow. I have a beach house in the Hamptons, and when I'm there and I open up those ocean doors and I breathe in that ocean air, I say wow every time. And I think New York City people want that experience. So we bought the land and we built twin towers there. And we had a topping off party a month ago. We're going to start renting a rental. We don't need to do condos.
What do you project your rental price will be per foot?
I think it's going to be between $60 and $70 a foot, depending if you want the penthouse or higher.
So you're saying your market rate apartments are going to be at $60 a foot?
Yes.
Okay. And what
and
size?
we have the ability. To build 3 other larger buildings, and we're negotiating with the city now. And what we're, pardon my, no caller ID. Who knows? And we're saying to the city that we want Coney Island to have its own skyline. The city knows I'm capable of writing that check. The city knows I'm stupid enough to write that check.
So what do you got, a nickel trolley?
Oh, we're going to put we're 8 blocks away from the subway. So what we're going to have is trolley cars, Coney Island trolley cars to take you to 2 places, the subway and Nathan's Franks. and it's going to cost a nickel. And if you don't have the nickel, we'll trust you. And it's going to play Coney Island music. It'll be just like San Francisco, those trolley cars going up in front, except it's not going to be electric trolleys.
Now, who do
it's
you?
going to be buses.
So here's the question: at $60 a square foot, in an area that we would once say was a two-fare zone, or AKA a schlep from Midtown Manhattan.
We're also
Okay, you know, who do you think is going to move there? I mean, we did have the large Russians move to Brighton Beach, okay? But there were the Russian stores, there were the Russian nightclubs, there were the amenities. Who do you project as your tenant mix?
You know, people, New Yorkers in Brooklyn, in Queens, have been very, very successful. We only have 425 apartments. I believe we're going to sell out faster than anybody thinks, because once you see these apartments, once you see that view, once you open up those ocean doors, and almost every apartment is going to have a balcony, you open up those ocean doors and you breathe in that ocean air, you say, wow, I want to live here. So I see no problem. We're also going to market to the people in Manhattan. We're going to have high-speed. We're working on a high-speed ferry service from Coney Island to Wall Street or Midtown. So what you do is, what a businessman does, you have to have vision. You need vision to create, but you also need vision how to make it a bigger and better success.
With regard to the vision, where do you see the opportunities today in real estate in New York City for yourself? I mean,
Well,
as an investor developer.
I look at opportunities. I look at the one thing, the big advantage we have. We're in so many businesses that we don't have to create. We don't have to build another building. But we look around for opportunities. So when we look around and say, "Wow, I can build a beautiful building," and I would say, "Wow, I want to live there." My other wow effect.
Here's two questions. One is, you know, unfortunately, most panels, most discussions fail to discuss the fifth borough, okay? What's your thoughts about the fifth borough, and any thoughts about what happened with the proposed wheel?
The wheel was meant to fail. They came to me and wanted to borrow another $100 million. And I looked at the deal and I said, if I gave you $100 million, we might break even by the year 3000. And it was just, you know, it was just dumb. We're looking at, when I ran for mayor, remember those days, 2013? When I ran for mayor, I proposed, and again, what does it come back to? Vision. I proposed a system to connect Staten Island to the MTA system of the rest of the 5 boroughs. And the way I was going to do it is have a high speed or low speed or whatever speed on the sides of the Verrazano Bridge, where it'd be like a unirail, monorail on the sides that will connect transit system of Staten Island to the transit system and the MTA of New York. And I think the word subways is not going to exist anymore. I think the word above ground, monorails, unirails, whatever you want to do it or call it, into the 21st century is the word. Because you can build monorails, unirails for, and I forget my numbers, I'm sure I'm wrong, for $1 billion a mile, versus subways, it's like $5 billion a mile, or a crazy number. I think the next mayor, whoever it may be, has to have the vision to take our city into the 21st century.
Question, I talked about the fifth borough. Let's talk about the sixth borough called Florida. Tell me what you're doing in Florida.
Again, diversification. I love New York. I will continue to invest in New York. If the city doesn't want to be able to give us what we need in Coney Island, we will invest even more money in Florida. Florida was saved with this last election. And believe me, I was a Bill Clinton Democrat, and I love Bill Clinton. But Florida almost got a socialist governor, which would have hurt Florida. And I'm not against the Democratic Party. It's just, you can't go too far. We live in a capitalist country. I am pro-business, but I'm pro-people too. But people have to realize that business people have to do well to create the jobs for the middle class to do well. And that's so very important. I think Florida is a great opportunity. The numbers are crazy. I forget, like 2,000 people a day or 3,000 people a day are moving to Florida. And I had the governor of Texas in my office a couple months ago. And guess what? Texas went from 18 million people 10 years ago to 28 million people. But people want to go into a position of less taxation, less burdensome. The problem we have, and a lot of people don't understand what Trump was forced to do when signing the last bill he did, where 44 states were given great deals and 6 states were given bad deals, and we can't make deductions. It was and if everybody remembers, that morning, Trump was jumping up and down because he didn't realize what the Republican Senate and the Democratic Senate and the Congress did to him. He didn't realize it till that morning. And he was jumping up and down. I refused to sign it. Do you remember that day? I refused to sign it. And they calmed him down. And, both the Republicans and the Democrats hate Donald Trump. But you want to know something? He's not the most easiest guy to get along with. But you want to know something? He's on our side. He's on America's side. And you always have to remember that. Does he have his peculiarities? Yes, he has his peculiarities. So Donald Trump made the decision, let me make 44 states happy and 6 states unhappy. And that's how that deal got done.
Okay, last question. What are you doing in Florida? Which you spoke about Florida, but you haven't told me what you're doing. I know, but the other people don't.
In Florida, like I said, we were all over Florida with 40 shopping centers back in the 80s. My in-laws used to live in St. Petersburg. They've since passed away. St. Petersburg, Florida. Tampa, St. Pete is a very big growing area. And it's mostly Midwest people. The Eastern Coast people go to Boca Raton, Palm Beach, Miami. The rest of America goes to the West Coast of Florida. And it's growing. And this opportunity came along. And, I'm driving around St. Pete. A lot of my friends are there. And this opportunity comes along where there's 8 family members and a real estate trust that are arguing with each other. And you know me, I could sit down and make a deal with anybody. And I sat down with the 8 family members and the REIT. Guess what? I made a deal. Downtown St. Pete, a block away from the bay, we bought 2 or 3 city blocks, and it's right in the best part of St. Pete. And we bought it for nothing. And we can build 1,600,000 square feet. And if you figure out my cost per square foot on 1,600,000 square feet, you ready? I'm glad everybody's sitting down. I wrote a check for $10 a square foot.
I was going to say 8, knowing you.
I just wrote the check. I mean, I can sell it for triple that or quadruple that, but we're going to build. And there's going to be condos, because in Florida you have to build condos. You can't ride the rental market in Florida. And we're going to have a Marriott right attached to it, and an office building. So it's going to be a combination hotel, office, condos, commercial stores. And it's going to be the highest building in St. Pete, Tampa. And we had to get FAA approval because there's an airport in downtown St. Pete. But it's going to be a great project. And you know what I tell my kids? I want to build a project that I can look at and say, wow, I'm proud of it.
And you've been proud of your projects, and you've done a great job. As I promised everyone, we'll be out by 10:30. Are there any questions for John?
Must be one question.
No questions. Thank you, John. Thanks for everybody. Frankie Friedman for putting on this wonderful group.